Picture a quiet office with a folder that decides whether your family keeps the life you built or sells pieces of it in a hurry. The tab on that folder reads something boring, transfer tax. But inside is one of the most powerful levers in U.S. tax law, the federal estate and gift tax exemption. People call it the $13 million secret, because right now, the exemption sits in that neighborhood per person, adjusted each year for inflation. It's not a loophole, it's the rule book. And if you understand how it works, what counts against it, how to share it with a spouse, when it resets, and how to pair it with smart documents, you can turn a bureaucratic number into a family safety system. Let's name the players. The U.S. doesn't run just an estate tax at death. It runs a unified system. One lifetime meter that covers taxable gifts you make while alive and the value of your taxable estate when you die. That meter is your lifetime exemption, also called the basic exclusion amount. Use it during life with big gifts, or save it for your estate, or split the difference. When the meter hits zero, future transfers are generally exposed to transfer tax at up to 40%. Parallel to that is a twin you mustn't ignore, the generation skipping transfer, GST, exemption, roughly the same size, which shields gifts or trusts for grandchildren and further descendants from a separate layer of GST tax. 2 meters, one strategy. Now the headline everyone hears at dinner. We each have about 13 million. True in spirit, slippery in detail. The exact dollar figure floats with inflation each year, and there's a ticking clock called sunset. The 2018 law that roughly doubled the exemption is set to expire after December 31st, 2025. On January 1st, 2026, the exemption is scheduled to shrink to about half, still inflation adjusted, but dramatically lower than today. That's not gossip, it's in the statute. The IRS has already said that if you use the larger exemption while it exists, it won't claw it back later just because the law shrank. Translation: high net worth families have a use it or lose it window for lifetime planning before the sun sets. How does the meter actually move? Think in 3 rings. The outer ring is free space, transfers that don't touch your lifetime meter at all. These include the annual exclusion, small gifts you can give to as many people as you like each year without filing a gift return. For reference, it was $18,000 per person in 2024. Check the current figure when you act. Also free, direct payments to schools for someone's tuition and direct payments to medical providers for someone's care. Those can be unlimited if paid straight to the institution. Add charitable gifts and gifts to a U.S. citizen spouse, both generally unlimited. None of that burns your lifetime exemption. The middle ring is exemption spending, larger gifts that exceed the annual exclusion or involve more complex property. Give your child a rental house, move appreciated stock into a trust, or transfer a business interest. That's where you file Form 709, report the gift, and subtract it from your lifetime meter. You can also gift split with your spouse, so a gift from one of you is treated as if made half by each, effectively doubling the annual exclusion and using both lifetime meters if needed. Gift splitting requires both spouses to file and agree. It's paperwork, not magic. The inner ring is taxable territory, transfers beyond what your remaining lifetime meter will cover, whether during life or at death. That's when the 40% rate becomes real. But remember, few estates pay federal estate tax because most never cross the threshold. The families who do are the ones who should be most deliberate, because a handful of decisions, timing, titling, and trust design, can swing 7 figures. What happens at death? Your executor lists your assets at fair market value on Form 706, applies deductions, debts, administration expenses, charitable bequests, the marital deduction, and then subtracts any lifetime exemption remaining. The IRS offers 2 special tools here. One is the alternate valuation date, a 6-month after death snapshot you can elect if it lowers both the gross estate and the tax. The other is portability. If you're married and your spouse dies without using all of their exemption, you can capture the unused amount as a survivor, the deceased spouse's unused exclusion, or DSUE, but only if a timely estate tax return is filed to elect it, even when no tax is due. It is the most forgotten million-dollar form in America. Want the short version? If your spouse dies, file the portability election. It preserves a second exemption for the survivor's future gifts and estate. Before we sprint into tactics, don't skip the income tax angle that often matters more in everyday life. Basis. Assets in a decedent's estate generally receive a step-up in basis to fair market value at death. That can erase accrued capital gains and make future sales less painful for heirs. Lifetime gifts do not get a step-up. The recipient takes your old basis. That's why a blanket, give it all away now plan can backfire for highly appreciated assets if you're nowhere near the estate tax line. The art is balancing estate tax exposure against income tax savings across the family. So, what can you actually do while the exemption is still generous? Start with simple, high-impact moves. Title and beneficiary cleanup is free leverage. Make sure accounts have up-to-date transfer on death designations. Insurance and retirement plans have living, correct beneficiaries, and real estate titles match your plan. Establish or update core documents. A revocable living trust for each spouse, wills, durable powers of attorney, and health directives. Those don't save tax by themselves. They make your plan executable when the clock is loud and the room is tense. If your net worth is likely to exceed the post-sunset exemption, you graduate to tools that move appreciation out of your estate while you still control the movie. A workhorse for married couples is the SLAT, a spousal lifetime access trust. One spouse makes an irrevocable gift to a trust for the other spouse and descendants, using today's larger exemption. The trust can invest for the long term, benefit the family, and keep future growth outside both estates. The trick is drafting 2 SLATs, if you do one for each spouse, that are not mirror images, to avoid reciprocal trust problems. While you're at it, pair big illiquid assets with valuation discounts. Transferring non-controlling, non-marketable interests in a family LLC or limited partnership can legitimately reduce reportable value because the interests are harder to sell and lack control. Discounts don't invent losses, they reflect reality. For entrepreneurs with volatile upside, the Grantor Retained Annuity Trust, GRAT, is a metronome. You transfer growth assets to a short-term trust, retain an annuity back to yourself based on a government interest rate, and pass the excess appreciation to heirs with little or no use of exemption if the assets outperform the rate. It's math, not mysticism. And in choppy markets, rolling GRATs can keep skimming growth into the next generation. If your biggest risk is a forced sale to pay estate tax, common with business owners or real estate families, think liquidity planning. A properly drafted, irrevocable life insurance trust, ILIT, owns a policy on one or both spouses. The death benefit arrives outside the taxable estate and can lend to or buy assets from the estate to raise cash for taxes, keeping operating companies and legacy properties intact. Tie this to a buy-sell agreement for a closely held business, and you've turned a panicked auction into a scripted transfer. Charitably inclined families have elegant options that also move numbers. A donor-advised fund can bundle lifetime charitable gifts, securing an income tax deduction in a high-income year, while letting you grant to charities over time. For bigger planning, a charitable lead trust pays charities first for a term, and then passes the remainder to heirs, often using little exemption if rates and markets cooperate. A charitable remainder trust does the reverse. It pays you or a beneficiary an income stream and leaves the remainder to charity, useful when diversifying a single, highly appreciated position without triggering a crushing immediate capital gain bill. Now layer in the GST exemption. If you want wealth to survive not just estate tax at your death, but also estate tax at your children's deaths, you allocate GST exemption to long-term trusts, sometimes called Dynasty trusts, where state law allows, so that distributions to grandchildren and later descendants are free of the extra GST layer. Here's the catch that trips up good plans. Unlike the estate tax exemption, GST exemption is not portable between spouses. If you want GST-protected trust for the family line, you have to allocate each spouse's GST exemption deliberately while both are alive or on the first death. Portability will not rescue you later. What about your house, your lake cabin, or the family home you know the kids will keep? A qualified personal residence trust, QPRT, allows you to transfer a home to a trust at a discounted gift value while you retain the right to live there for a term. Survive the term, and the home is out of your estate. Die during it, and you're back where you started, no worse than before. QPRTs can be useful in a high exemption window if real estate is a major slice of your value. For married couples with uneven estates or second marriage complexity, marital trusts are the balancing act. A QTIP trust, qualified terminable interest property, lets you leave assets in trust that must pay income to the surviving spouse for life while preserving control of where the principal goes at the survivor's death, often to children from a prior marriage. QTIP planning also lets the executor decide how much to qualify for the marital deduction on the estate tax return, a flexible dial at a stressful time. If your spouse is not a U.S. citizen, you swap to a QDOT, qualified domestic trust, to preserve the marital deduction under special rules. Everything so far is federal. Don't let a state sneak up on you. Several states run their own estate or inheritance taxes with thresholds far below the federal number. Think single-digit millions or less. And some have separate rules that snag gifts made shortly before death. If you live in, own property in, or might die in one of those states, map the state exposure now. A simple relocation, a change in property titling, or state-specific trusts can be the difference between no state tax and surprised at closing. Let's walk through 4 quick stories so the gears stick. First, a couple with a combined net worth around the current federal threshold, most of it in retirement accounts and a fully appreciated brokerage portfolio. They keep their assets titled in revocable trusts, update beneficiaries, and elect portability when the first spouse dies. Because they hover near the line, but not far past it, they prioritize basis. They avoid gifting highly appreciated stock during life just to use exemption, because the step-up at the first death, and again at the second, can erase capital gains for heirs. The win here is not cleverness, it's restraint and a filed portability election. Second, founders with a business worth more than the post-sunset exemption. They use the remaining high exemption window to fund a SLAT for descendants with non-voting interests in a holding company that owns pre-IPO shares, respecting governance and valuation. They add a rolling series of GRATs funded with the most volatile slug. They buy life insurance in an ILIT to create estate liquidity and a cushion if markets are unkind. If sunset arrives in the exemption halves, they've already moved the rocket fuel outside the taxable blast radius. Third, a real estate family with low basis properties and strong cash flow, but taxable if the parents died today. They recapitalize properties into an entity, transfer discounted minority interest to trusts up to the remaining exemption, and put a QPRT around the primary residence. They keep key assets in the parents' names to harvest a step-up later while using the exemption to move appreciation. They also draft a buy-sell funded by the ILIT, so estate tax doesn't force a sale in a down market. Fourth, grandparents who care most about the next 2 generations together. They establish long-term discretionary trusts for descendants and allocate GST exemption fully, so future distributions and growth avoid GST and estate tax through multiple nodes. They make the trusts grantor for income tax purposes while they're alive, so they personally pay the income tax on trust earnings, an extra stealth gift that doesn't consume more exemption. Then consider toggling grantor status later when it suits cash flow. A plan is only as good as the forms that backstop it. During life, large gifts trigger Form 709 each year you exceed the annual exclusion, or split gifts with a spouse. At death, even a non-taxable estate may need Form 706 if you want to elect portability. The IRS currently allows a simplified late election path within a generous window after death, but don't depend on leniency. Calendar it and file. Trust moves create a paper trail. Appraisals for hard-to-value assets, entity agreements for discounts, insurance policy pages for ILITs, trust tax IDs and bank statements, Crummey notices if your ILIT relies on present interest powers to qualify annual exclusion gifts that fund premiums. Documentation isn't the garnish, it's the meal. What about retirement accounts and the new 10-year payout rules for many beneficiaries? Estate tax and retirement account rules intersect in awkward ways. Naming a conduit trust can force unwanted acceleration. Naming individuals may be simpler, but risks poor discipline. Thread the needle by segmenting beneficiaries, spouse outright or with a marital trust, minors through carefully drafted accumulation trusts, charities as direct beneficiaries of IRA slices to avoid income tax entirely on that portion. The exemption doesn't fix income in respect of a decedent rules. Beneficiary designations do. If you feel the ground shifting under your feet, that's because it is. The exemption changes each year with inflation, and the scheduled sunset after 2025 could cut it roughly in half. Congress can always rewrite the script, states can move their targets, and markets can change the math on what to transfer. Your defense is a living plan, one that you revisit annually with dials you can turn, trusts that allow swaps of assets, GRATs you can roll, ILITs with sensible premium paths, documents that let executors choose QTIP elections, and alternate valuation dates with eyes open. The $13 million secret isn't really a secret. It's a quiet invitation. The government gives every American a once-per-lifetime shield you can point at the right assets in the right order. If you ignore it, nothing happens, until everything happens at once, and your heirs discover how much urgency costs. If you use it thoughtfully, you don't just save tax, you buy your family time, options, and calm. A number on a chart turns into a college decision that isn't about selling stock at the wrong moment, a business handoff that doesn't require an auctioneer, a cabin that hosts more summers instead of a listing that funds a liability. Open the folder. Write down what you own and what you want. Decide whether this is a year to harvest step-up, a year to harvest exemption, or a year to do both with different assets. Elect portability when it's offered. Allocate GST when it matters. Fund the trust that keeps your story going. And remember that the IRS didn't hide the ball. It put the rule in plain sight and gave you a pen. Use it while the ink is still wet.